In today's video, we are going to be breaking down the American banks and if they are a good investment. Obviously, as you know, if you've been following this channel, I am a massive fan of Canadian banks, but what about these American banks? Are they any good? I'm also going to be giving you a very good option that I play with the American banks as well. So let's get down, let's check them out. So first is Bank of America. I used to own quite a few shares of Bank of America. I rode them all the way from about $15 all the way up to about 31 or 32 if I remember correctly. And it was fantastic. I wish I still owned at least half of those shares. However, their dividend is a lot lower. Most of the American banks, their dividends will be lower than the Canadian rivals. However, at 1.7%, you're still looking at a very good yield for a bank that's going to potentially have some big growth, of course, if inflation hits and interest rates go up. Bank of America has been historically very, very good, making record profits anytime there is a big interest rate. Their average volume is 47 million shares traded every single day. You can play with this with options. You can play this by the long game by just buying and holding forever. But I think the banks in the States have been set up really well after the 2008 crisis because now they have to be a lot more careful with their money. However, the American banks, a lot of them will have a lot higher PE ratios than the Canadian counterparts. Just like the Canadian banks, they did trade, a lot of them anyways, did trade sideways for a while. And just when Bank of America was starting to break out, we seen the coronavirus pandemic hit. And of course, they did trade sideways for a little bit longer than the Canadian rivals, but all of them have done this massive uptick in their stock price. A lot of the banks have slightly pulled back recently. However, if interest rates do increase, I would assume also that Bank of America's stock price will also go up. Next is their dividend, and this was the reason why I originally purchased Bank of America back when they were worth a lot less. And that was because they only had a penny dividend, which is a lot lower on this chart, but now they're sitting at 18 cents per share. They were not allowed to do a dividend for a very long time after the 2008 crisis, but ever since then they've been able to increase it from a penny up to 5 cents to 7.5 cents, up to 12, up to 15 cents, now up to 18 cents, and once they're allowed to start raising dividends after COVID, they're going to be able to raise them again. And as you can see here, this is what I was talking about, a penny. That was all they were paying for the longest of times, and I was in at them in 2014-ish, 2013 if I remember correctly, and then of course they increased since then. However, their last couple of quarters, they've all been beats. They did make less money when it came to 2019, when it came to revenue, but their earnings did not suffer, and then of course revenue dropped a ton in 2020, and so did their earnings, but they obviously, just like every other company in 2020, they were cutting staff. They were also really reducing costs. So now they are an even more slimmer company, which means that there's going to be higher profits, hopefully. Next is JP Morgan. JPM is the ticker, and this one has a lot higher of a dividend at 2.3%. It does trade at 14 million shares every single day, and of course its PE ratio is more in line with what the Canadian bank's PE ratio is, which is 12.22. Now this one to me would be a much better investment than Bank of America right now. However, I just like banks in general. They essentially, in my opinion, they print money. Even though they don't, they basically do. If you go to the 5-year chart, this was one of the few banks that never traded sideways. It continued, even though it did trade sideways for about a 1.5 year period. It did started to have an uptick before the COVID pandemic, and of course since then it has accelerated, and it's starting to look like it may start to trade sideways yet again. But if it does, that just means it's a buying opportunity because of course it's going to rise up again eventually. And during that time, it's trading sideways, you're still collecting a very, very good dividend. They do raise their dividends quite often. They went from 50 cents up to 56 cents, up to 80 cents, 90 cents now. And of course, they've had to freeze it at 90 cents, not increasing right now because of COVID. But once they're allowed to increase the dividend once again, then they'll be all set for massive raises, I would assume. That's what I've been kind of calculating with the Canadian banks. They've also been killing and crushing earnings as well, just like most of the other banks every single quarter. And just like all the other banks, they did have a downturn in 2020. Their revenue was down, their earnings were down. However, if we look at the previous or the years prior, we can see that they were making more money and making more earnings each and every year. Next is Wells Fargo. This is WFC on the stock market. This one has a ridiculous PE ratio. I would not personally be investing in this one. It also has a 0.88% dividend yield. However, the thing with banks is, even though it may be going through hard times, and of course the shorts may be coming in and whatever else, there is something that I do always live by when it comes to the Canadian banks, and I would also say that this could go for the American banks as well, and that is the fact that whenever a bank is hurting, it's usually the time to buy because they're going to fix themselves, and then they're going to turn around a year, 2, 3 years later, have crazy earnings because they've basically slimmed down their spending, and then they can turn around and just expand and do crazy stuff. Like National Bank, like 7 or 8 years ago, I was getting in at just cheap valuations, same as Bank of America. I was getting in at cheap valuations, and then of course it ran up. I still own National Bank. I did sell Bank of America, however. So of course, if you do your homework and due diligence, if you think that this company, Wells Fargo, could do that, then of course that may be a great way to play this stock if you're looking at it as a 5 to 10 year company. It does trade at an average volume of 28 million, so that's going to be easy to get in and out of. Its 5-year chart basically trading sideways, not really doing too much. Of course, it had a very good beginning of 2018, but that's about it. It's also lowered its dividend as well, which is quite scary if you think about it this way. It's almost like the National Bank theory, or not National Bank, Laurentian Bank idea, where they seem like they were doing not bad, not terrible, and then of course they come out with a dividend lowering. So Laurentian Bank, I got out of it a while ago, and I was never in Wells Fargo at all. However, again, always do your due diligence. I don't think this is a fantastic company to be in. However, at the same time, it may be a good turnaround story. As we can see, they were making less revenue and less earnings every single year before COVID. COVID hit and they got absolutely decimated. They missed 2 earnings out of the last 4, but they did beat the last 2, so that's kind of good. Now, the one that everyone who I talk to basically talks about is Goldman Sachs. And Goldman Sachs is obviously a massive, massive company. They do have a 1.3% dividend, which isn't big enough for me to say, hey, that's a dividend play. But look at their PE ratio. It's 9. This is an extremely cheap bank right now when it comes to the PE ratio. Its average volume is 2.8 million shares, so you can get in and out of it quite easily, and it's trading at $365 per share. Goldman Sachs, ticker symbol is GS, and it's down 1.5% today at the time of making this video, and it was trading pretty well sideways up until the coronavirus, just like everything, and then since then it has accelerated massively. It has been raising its dividends quite often, and it did have, just before the coronavirus pandemic, it did have the massive, ridiculously stupid jump of 85 cents up to $1.25 per quarter. So that just tells us right there that they were looking very, 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 very good coming into the future until, of course, COVID hit. Now, this is the part that just absolutely blows my mind. Yes, they did miss the first out of the last 4 quarters. However, the last 3 quarters, they have beaten it massively, and check out their financials. Every single year other than 2019, their revenue has been going up, and same as their earnings. 2020 hit with COVID, and look at that. Amazing. They had the best year, I think, ever with their revenue, topping over $40 billion and close to $10 billion in earnings. Absolutely amazing, especially when all the other banks were not doing that great. Between Wells Fargo and, of course, Citigroup, which is what I'm about to talk about, both of them have extremely low PEs, and I'm an absolute huge fan of them right now. Now, they don't technically, or at least Wells Fargo isn't exactly a massive dividend play. They could raise it again massively into the future. Citigroup has a higher dividend, but their PE ratio is also extremely low. So between Wells Fargo and Citigroup, Citigroup's ticker symbol is C, the letter C. Its PE ratio is 9.62, and it seems like it's a very good deal right now, especially with its dividend at 2.85%. From there, its average volume is 18 million shares traded per day, and it currently trades at $70, down $1.31 today, which is 1.8%. It's a good buying opportunity maybe today. We'll see. What's it at now that after I've recorded this video? Yeah, down 4%, 4.5%. So absolutely fantastic buy right now. Its 5-year chart is very interesting. Up until 2018, it was increasing in price, and then it basically traded sideways, upside down, head and shoulders pattern at the end of 2019, which is quite interesting, which is why it did rise up a bit from 2019 to 2020. But of course, coronavirus hit, had a massive, ridiculous double bottom, multiple times actually, and then of course increased since then. It's back up to its near where it was trading at before COVID, very close to it anyways, and I think that this could have a good run going. However, as we can see in the news portion, Citi Group is their shares are dropping mainly because the CFO warns of rising expenses and falling revenue. However, at the same time, when you're looking at the charts, the actual revenue was pretty well even. Their earnings were going up, which means that they were really cutting down on their expenses. So 2020, I'm not too worried about because, of course, everyone was down. When you look at the quarters, they are beating the individual quarters, and we can see that they are raising their dividends. They haven't been lowering them yet. So that just, to me, that shows a pretty good future. Now, this is a good way to play it. Now, I'm showing you the information of this ETF on the actual TD app, mainly because Yahoo Finance just was glitching out and was not allowing me to see any information about the ETF. So I thought I would show it to you from here. It's currently down at the time of recording this video. Its last price was $30.23, down 32 cents. And of course, the ticker symbol for this is ZWK. It's a BMO covered call US bank. This pays a ridiculous dividend. Its dividend yield at the time of making this video is 7.14%, so absolutely fantastic. Basically, it's making its money to pay the dividend by essentially basically running selling calls against the shares that they have. So this is one way that you can make money from on a dividend stance, and it's a way that I like to play the American banks. Its MER is 0.71, which is in line with all the other covered calls, and its top holdings is the one I really like, Wells Fargo, number 3. Ameriprise is another one of its top holdings, and First Republic Bank. And then, of course, there's also Citizens Group, which is a pretty good bank as well. Signature Bank is another good one that stands out to me. So all very good holdings, and on top of it, you are getting a massive dividend. So that's my take on the U.S. banks. Wells Fargo, in my opinion, is one of the better ones to invest in right now if you're going to a singular stock. One way that you can play it is through ZWK, the ETF. You're basically playing the stock itself while getting a massive dividend from selling call options against the stock. Now, from there, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe. I'll see you guys again next time.